As an operator, you look at what sort of return are we achieving through investment in operations, and if we have that money invested in real estate, what's kind of the implicit return that we're receiving in our own real estate. And then there's the compliance thing to think about. If you have physicians who are lessees, what sort of risks do we have, and do we have to hire some outside consultant like Victor or a broker or something to help us sort through our real estate lease compliance issues. So there's kind of a wide array of I think financial, strategic, compliance that you think through if you're a healthcare operator in deciding, do I want to own my real estate? Do I want to lease my real estate? If I want to sell it, what do I want to commit to in terms of a lease term? Do I want it to be in a joint venture? Lots of options.
Welcome to this week's episode of the Providers, Properties, and Performance podcast, where I interview Victor McConnell, Managing Director and Head of Real Estate Services at VMG Health. This is part one of a two-part episode, and in this episode, we talk about how evaluating healthcare properties involves the real estate portion plus the operational portion with regard to the healthcare company or healthcare companies occupying the property. And with the healthcare companies, how important it is to understand the value of your real estate. And then next week, we dive into trends in the healthcare and healthcare real estate industry that were happening pre-pandemic and that are likely to happen post-pandemic. And I hope you enjoy both episodes. All right, Victor, welcome to the Providers, Properties, and Performance podcast.
Thank you, Tricia. I'm happy to be here.
So why don't you start with sharing with the audience what does VMG Health does as a whole for the healthcare industry, and then specifically the real estate services that serve the healthcare industry.
Yep. So VMG is a healthcare M&A advisory valuation firm. We were founded in the early 90s, originally doing primarily business valuations of everything from physician practices up to entire hospital systems. And then over the last 20 or so years, we've added other service lines like PSA, valuation of compensation arrangements, quality of earnings, black box, capital assets, equipment, and where I sit, real estate, we've had for about a decade. And our real estate service line works exclusively with healthcare related properties. Sometimes we're engaged by hospital systems or physician groups or private equity. It could be real estate focused or operationally focused private equity. And then we also do a fair amount of litigation support work and then other consulting work that has often a valuation component.
And VMG Health serves clients nationally, or is there a specific geographic focus?
We do nationally and then occasionally internationally. We actually valued a 1 million square foot hospital in the Middle East a couple of years ago.
Interesting. So you began your real estate career as an appraiser, and when did you start to focus on healthcare real estate?
I did some healthcare real estate starting probably around 2008. I had a bit of an atypical path. I was a creative writing major at Dartmouth in undergrad, and kind of fell into the real estate world by happenstance. And I've been doing work with VMG since about 2012 or 2013.
That is interesting. It's interesting how our career paths wind.
What? Life never goes as we expect it to, right?
Exactly. So, I'm excited to have this interview because I really want to selfishly pick your brain on some healthcare trends. But before discussing that, healthcare companies are making strategic decisions all the time, either for long-term strategic goals or current market conditions that they want to take advantage of. And understanding the value of their real estate, that's real estate assets under management, fair market value versus book value, or the annual run rate, which is either the cost to operate that real estate or lease costs as well. how important is it for healthcare companies to understand the value and cost of their real estate expense, and you know, and then after that, how they align the cost of the real estate with the operational costs, and make strategic decisions and plans?
Yeah, I think as I'm sure you've seen and experienced, I think the way real estate is thought of within the healthcare world, whether it's on the investor side or on the operator side, has changed a lot. Real estate is typically the largest item on a hospital balance sheet. So in any sort of hospital transaction, one hospital acquiring another, or a joint venture or anything like that, real estate maybe 20 years ago was more of an afterthought. I think now hospitals think about it more strategically, and they realize maybe more how real estate fits into strategic plans, both from a geographic footprint perspective and also from a hospital campus perspective, as where and how we can provide care changes, what's needed on the actual campus changes. And then there's also more investors who are interested in owning healthcare real estate and who understand it better. And so they may be more willing to invest in, say, an orthopedic hospital or a surgery center or a cancer center, or property types that, again, in the past may have been perceived as highly specialized and only a very small group of investors would be interested. Now I think that pool is larger. So wherever you kind of sit in the healthcare real estate spectrum, there's, I think, a greater understanding of complexity and of strategic importance when it comes to how real estate fits into the overall kind of healthcare business.
And just for some financial advantages of understanding their real estate, I pick maybe insurance and changing that against the value, some capital asset valuations if they're wanting to renegotiate a loan or put new debt on a property, negotiate some leasing, some ground lease valuations, like you said, for campus, and then, Stark regulations. And so can you touch on a couple things about those that could be advantageous for a hospital or health group to use their valuation to benefit them?
Yeah. I mean, if I were a hospital and I was thinking about my real estate, I'm thinking, what can I do with it? It's a tool to provide patient care, but it can be a tool for, say, physician alignment. I can choose to enter into a joint venture with some physicians in developing a new property that may align with the strategic objectives of both the hospital as well as the physician group. Those can be complex. They can require parties to consider, what's the value of say, a lease guarantee, or who's going to be responsible between the parties for which aspects of development. And then some hospitals may prefer to own because maybe they have kind of nonprofit considerations where there's a tax exempt status that they have to consider, or they can get money from large donors who can put their name on a cancer center, and that's something that may not be possible with outside capital. On the other hand, you as an operator, you look at what sort of return are we achieving through investment in operations, and if we have that money invested in real estate, what's kind of the implicit return that we're receiving in our own real estate. And then there's the compliance thing to think about. If you have physicians who are lessees, what sort of risks do we have, and do we have to hire some outside consultant like Victor or a broker or something to help us sort through our real estate lease compliance issues. So there's kind of a wide array of I think financial, strategic, compliance that you think through if you're a healthcare operator in deciding, do I want to own my real estate? Do I want to lease my real estate? If I want to sell it, what do I want to commit to in terms of a lease term? Do I want it to be in a joint venture? Lots of options.
Oh, sorry. Go ahead.
No. And then, where I would fit in, or where VMG would fit in, from a kind of third party valuation perspective, we help our clients kind of sort through those options. It could be as simple as a physician lease renewal or something, and they need a third party opinion on what's a fair market rent renewal for the surgery center, this medical office building, or the specialty hospital. In other cases, it could be a more complex transaction where, like I was mentioning earlier, it's a new project, it's a joint venture on a development, and there's a lot of different pieces to it. One of which includes real estate, and there's also other operational considerations that they need third-party assistance to help sort through and make sure the transaction's commercially reasonable and within kind of fair market value parameters.
And do healthcare companies ever come to you and say, hey, we want to kind of understand what the value is of our real estate in order to maybe take advantage of some market conditions, like right now when cap rates compressing, or they have a lease coming up. Would it make more sense to purchase a property? Do they ever come to you with those sorts of questions?
They do. I mean, they may talk to their broker, but obviously that sometimes they think, well, is our broker has an incentive for us to sell, but yeah, that's something. Sometimes we'll have, say with a lease renewal, maybe a company with a sale, we've done analysis where, say, if we commit to a 5 versus 10 versus 15-year lease term, what does that do to cap rate in a sale? And then if you're in a joint venture, how do you distribute the profits between, say, hospital and physician, or strategically, what are you comfortable committing to from a lease perspective? In terms of assessing market conditions, it's somewhat of a double-edged sword. Obviously, cap rates are correlated with cost of capital to some extent. So again, if I'm a healthcare provider, I'm debating, what do I want to do, a sale leaseback or sell this property, or do I want to borrow money? And so you're kind of looking at those two things, hand in hand, because if you can borrow money at 4%, that may or may not be attractive than doing a sale leaseback at a 5.5 or 6% cap rate or whatever it is.
Exactly. But the common denominator between all of those decisions is understanding what you're, understanding the value, the current value of your real estate, which fluctuates.
That's absolutely right. And then, and understanding it in the context of both. I think it's important to think about it in the context of both an owner occupant as well as from an investment markets perspective. Sometimes those two are aligned, and sometimes there's a difference there. And theoretically, if the investment market has a stronger kind of valuation, then you could make an argument that the owner occupant should more strongly consider looking at a potential investment sale. But yeah.
So do you have any healthcare companies that like to perform this analysis like on a quarterly basis, or do you get a lot that are like, hey, we have a problem to solve and we need your help on this particular situation?
Yeah, I mean, you have, there's the REITs that will do, quarterly updates and such for financial reporting. The hospitals don't have the same requirements to report, say, real estate values. So I generally don't see that. I mean, I think a sort of top to bottom system assessment of real estate is done less frequently by hospitals. and it can be done from a strategic angle, what you're getting at, like understanding, hey, what sort of value do we have here? How do we want to use this real estate, either as collateral and in a debt issuance, or do we want to sell any of it? Maybe I was talking with a hospital real estate person who said, hey, we have 400 sites of care, owned or leased properties. We don't know what the right number is. Maybe the right number is 250, maybe the right number is 450, but we understanding strategically what we need from a sites of care perspective. And then the second question is, do we want to own or lease those sites of care? Both of those are kind of internal questions for a system to sort through that tie back to your comment about understanding value. The other part, I think, that's updated maybe a little more regularly, that hospitals take different approaches on, is their rent analysis. Some hospitals will do it on a case-by-case basis. Others have internal kind of market studies. Others hire external firms to do studies on an individual market, or they have brokers or appraisers do it. And in terms of timing, again, that varies. I've seen anywhere from 1 to 2 to 3 years, generally, on how often are we taking a hard look at what I would call FMV rent, fair market value rent. So I don't know if that answers your question.
Yeah, no, it does. It does. So, when I prepared this, I was saying, now that we're heading out of the pandemic, and now, we're having some hiccups, but in general, I mean, what has the pandemic done as far as making decisions for healthcare companies that they may have not considered pre-pandemic that you're seeing? I mean, obviously there's the basic ones, but are there any new ones that are coming across your desk as a result of the pandemic affecting them?
Well,
some decisions.
I'll pretend that I perfectly understand all of the short and long-term consequences of the pandemic on like all aspects of social and economic life, including the healthcare real estate sector.
Just healthcare companies.
No, well, even that, I think the story that you read, I think again and again, is one of variability across our economy, and I think the healthcare real estate sector is no exception to that. So, you've seen, and another common theme is kind of the large getting larger, the financially well-positioned hospital systems coming out of it doing okay, or in some cases having an even stronger market position, and then those who were more vulnerable being in maybe even more dire straits. And so how does that impact real estate? Well, it depends. It depends on what your market looks like from a kind of market fundamentals perspective, and then what sort of asset class are you in? Are you in skilled nursing or assisted living, or are you in inpatient rehab hospitals? Are you in medical office buildings, surgery centers, urgent care, freestanding EDs? There's a different reimbursement environment, different kind of payer environment. Well, I guess saying the same thing a different way. And then geographically, the markets that there's a lot of population growth and kind of things that drive fundamental real estate demand. Those are the same markets that, generally speaking, are doing better. And so the hospitals in those markets are grappling with a different set of decisions versus your tertiary or more rural hospital, which is struggling to keep its doors open and maybe has excess space. So I think it's a complicated story. I mean, the things that people have been talking about for a decade, outpatient migration, those are all, of course, still happening. They're manifesting in different ways. The freestanding ED urgent care. You and I talked about a little bit in our kind of preparation. That's I think a good example of one model that had some serious struggles and another that's been had more consistent growth. But both kind of trying to do the same thing, trying to capture patients who would otherwise be going elsewhere into a different outpatient setting. Same thing with surgery centers, which have been on a multi-decade growth trend that's hasn't really changed. There's still that flow of surgical procedures that used to be able to be performed in a hospital, or that used to have to be performed in a hospital. Now they can be performed in an outpatient setting. What does it mean? Well, if it's spinal or hip, you may need a larger OR. You may need, some design changes to your surgery center to be competitive. So that was a long, sprawling answer, but I think
I like that.
I think it's a complicated question in terms of I think I guess my short answer would be a lot of the trends pre-pandemic remain in place. I think some of those maybe have been accelerated, would be what I would say. And that the big have gotten bigger and the small are struggling more, would be my soundbite.
Right. And maybe like the hospitals that were already putting their outpatient services out of the hospital and really having the hospital focus on acute care and higher acuity care, versus those that might have thought about it or not quite developed the strategy. I'm thinking the ones that have already started that process and have the ability to just implement it faster, might have a lot more long-term success than trying to do it while they're going through the pandemic and having to deal with that as well.
Yeah, I think that's true. If you were already kind of out in front of some of those trends, then you're probably handling them a little better now. I mean, I think there's still some unanswered questions about, how durable some of the pandemic effects will be. Telehealth is the one everybody cites. I talked to a hospital in the West Coast early on, and they had done like in the first 2 weeks of March of April of 2020, they did something like 3 times the total amount of telehealth that they had done in the entire year previously. So, that obviously that's not going to stay at that level, but some amount of that care will remain. Patients still want to see the doctor for a lot of things, but there'll be some things that consumer preference will change, and healthcare provider preference and technological abilities will change. And I think that's still all kind of shaking out. I don't think anyone really knows for sure where it's all going to land.
Yeah, I think it's a great addition to use as a additional tool, but it can't replace it. But I think it's great for triaging. I think it'll be good for that. And then are you seeing healthcare companies kind of assessing so if they had some non-clinical space that, they want to reallocate and either convert to clinical, I'm sure some of their operational and administrative folks that are non-clinical that may be going to more of a hybrid workforce, do you see them kind of trying to analyze that and use the real estate, especially maybe the most expensive real estate, for their highest acuity clinical use?
Yeah, well, I think the admin space is one of the things that has maybe changed the most, and still, I think the healthcare sector, like a lot of the general commercial real estate sector, still doesn't know what they're going to require of their employees in terms of how many days a week are we going to come into the office? Are we going to use a hotel in configuration? Are we going to, what's our office footprint going to look like? I think those questions are still, they're still somewhat unanswered. And you see the news every week. Some large company announces a policy about people coming back into the office, and then they change the policy when there's feedback in one direction or the other. And I don't think the healthcare sector is an exception to that. So I think your comment about potentially rethinking how the healthcare community is using administrative space, I think is right. I don't think that there's a clear answer, but I was working with a health system that was considering an acquisition that they were going to use for administrative office space that was near their campus. They moved forward with the acquisition under the same terms as pre-COVID. This was a deal that had been discussed before COVID, and they closed on it a few months after. But they said, we don't know what we're going to use it for. I said, we're still going to buy it. We still think we're going to need it for something, but we don't know. It's by our campus. It was an old building that was going to be renovated. So I think in their case, they kind of looked at it and said, well, we don't think our space needs are going to be less. They may be different. We just don't know exactly what they're going to look like yet.
Yeah, no, I think that's fair too. So going back to, some of their, some growth strategies that, some may be able to implement faster, in order to implement them faster, do you see, I know hospitals, in my opinion, their capital should be used for mostly their operations, and, the real estate, obviously, that needs to house them, some of it. But when it comes down to it, their need to serve, to provide healthcare services, should be where in my opinion, a lot of their resources go to first. So do you see that in order for some of these healthcare companies and hospitals to implement some of their plans faster with regard to the real estate, needing the real estate to do it, are they more open to partnering with capital partners, development partners, and in order to implement this quicker and maybe share the risk?
Yeah, I mean, I think I think there still is kind of, not across the board, but a lot of hospitals prefer to own their on-campus real estate. Some don't. Some have changed the outlying areas, or to your point, if you're developing a string of outpatient clinics, of whether it's, I don't know, urgent care, primary care, I see more alternative structures there, whether in some cases it could be you have a development partner on the real estate side, and then you also have an operating partner. Maybe the hospital is partnering with an entity that specializes in whatever the platform is, a primary care clinic or an urgent care clinic. And so you may have participation on the real estate landlord position from the hospital or the physician or the operator who's partnering with the developer. And then on the lessee side, it could be any combination of those entities as well. And ultimately, I think what's going to drive what the right structure is going to be, the strategic objectives of those, of the hospital, of the physicians, of if there's a platform company that's operating it, how do those overlap? What sort of, growth kind of targets do they have? What's their capital availability? Do they have a development partner that they think has the right combination of, geographical and architectural and development expertise to develop what may be a specialty clinic type? And then what sort of debt can they get, depending upon the structure, depending upon who's going to be the owner, who's going to be the lessee, how high cost is it? If it's very high cost, then if I'm a lender, I'm going to look at it with greater scrutiny, because I know that if it goes dark, if it fails, the gap between the value of the property as built versus in a vacant scenario could be wider. So that means you have to do more diligence around either the lease guarantee or the operational projections, or both. So I think that I don't know if there's more, if to kind of your original question, if a greater percentage of those types of developments are using outside capital than they were before. but I think that there's a wider array of different structuring options, and that the potential different structures are maybe more. There's more to choose from. Even just strictly with a third-party developer, there's the traditional build-to-suit, yield on cost. There's the fully amortizing kind of CTL structure where it's more of a financing deal. And then there's a lot of kind of permutations in between.
And, I always recommend that you can consider several options until the one that becomes the most beneficial kind of appears. Do you see them do they ask you for some help in considering, like, evaluating the real estate and maybe giving them a little bit of idea based on their value of the real estate and where it sits on their balance sheet, kind of which direction might be most beneficial for them? Or is that like an additional level?
Well, it kind of, so some hospitals, it depends on how large and sophisticated their real estate department is, and what kind of internal capabilities they have. And then generally the real estate's not the driver, right? It's the, whatever the kind of operational or strategic focus is. It's how does the real estate help them achieve that objective? And that a lot of times that's kind of self-evident. If they have some physician partners that are interested in participating in the real estate, then that's the structure that's going to make sense strategically. You probably don't need to do a lot of financial analysis to figure that out. Same thing if you have a private equity platform company that doesn't want to own real estate, then that kind of eliminates some options right off the bat. And for us, it kind of depends on, in part, who's hiring us or who's asking the questions. Sometimes if it's a real estate investor client, a REIT, an individual, or private equity, their concern may be more on the risk side. They're investing in this specialty healthcare property it's a surgery center, it's a micro hospital, it's freestanding ED. They want to know what's their risk, and sometimes that risk is tied to, if it's a purpose-built asset, the risk is going to be tied to either who's guaranteeing the lease or the operational projections. And if you live and breathe the projections in that industry, then you can look at them and benchmark certain projections to help understand how likely is this tenant to pay or to default on their rent, which is the core question you want to ask if you're a landlord. And so how you answer that question, again, depends on
who you're representing.
It depends on where the risk lies. If it's a lease guaranteed by a parent hospital system, then the risk is probably more associated with that parent system. Whereas if it's a lease that's guaranteed by just the LLC that's specific to that surgery center, your risk is more, and the surgery center costs $700 a foot to build, then your risk is associated with the projections there. So ideally you want to have someone look at the projections and say, okay, they're projecting X in terms of arthroscopies, knee arthroscopies. Is the volume and the reimbursement reasonable? Are the operating expenses reasonable? Are they going to be able to pay rent? So that question in that case is more operationally focused, less about the real estate. That's what informs the risk. Whereas in other cases, it may be more of a real estate specific exercise.
Yeah. So now I want to move into a different trend. So I know private equity has gotten into buying. So it used to be hospitals a lot were buying and consolidating practices, and they still are, but private equity is as well, especially when it comes to vision. I mean, American Vision Partners is just gobbling up a bunch of ophthalmology brands, and then dermatology is another one. So do you think that this particular trend, and I I don't think it has been affected by the pandemic. Maybe it has. You can let me know. But I mean, I think that this trend will continue. I think just trying to some of these private practices, the operational side, they really just want to focus on serving patients, and having kind of a parent company take over the operational side is attractive. But do you think that this trend is something that's going to sustain?
I mean, in certainly the short and medium term, yes. I mean, there still is a lot of uninvested private equity capital, and just like the healthcare real estate sector, there's more that's willing or interested in investing in healthcare. And so, at its most basic, there's an arbitrage between buying an individual or group of practices and then rolling them up into a platform. Maybe the platform trades at a 10 or 12 or whatever multiple of EBITDA, and the individual or the group of practices that's being acquired by the platform may trade at, I don't know, a 6 or an 8. And so that gap is what's really driving, the profitability associated with that roll-up strategy. It's more complicated than that, but that's the core of it. And so that doesn't appear to be likely to change. There are questions about sustainability. Generally speaking, you have physicians who are carving out a piece of their historical comp in order to put a multiple on that in some cases. And then ideally there's income repair. The practice becomes more successful, and so the physician's annual income then returns to kind of pre-acquisition level. Obviously, if it doesn't, then that can be a challenge, because then you have a dynamic where physicians are, fast forward 3 or 4 years after the deal, they're doing the same volumes and making less income. They got the lump sum in the past, but so that's a dynamic that we'll see how that plays out over the next 5 to 10 years. And I think that one trend of the pandemic has been that you have more physicians that are probably interested in selling their practice and who are evaluating, do I want to go become an employee for the health system, or do I want to go, be part of a private equity platform company? And those are kind of very different paths that, depending upon maybe where a physician sits in their career or a variety of other factors, they're going to lean one way or the other. But the trend of private equity acquiring practice entities is, I don't think it's going away anytime soon.
Do you think having, in some cases it was just, 4 to 6 weeks of, having elective surgeries be halted? Do you think that might have tipped some people in the scale of, I don't want to deal with this again if it happens?
Well, anytime you're a small business owner, or you're, a physician who's in an individual or small group practice, and you have something like that, it drives home, I think, some of the increased risk. There's can be increased reward, but there's also increased risk with being in that position. So, I know in some markets, not all markets, I've heard hospitals say, oh yeah, we've had a lot of physicians who have historically have not really been interested in a practice sale and who are now interested.
Yeah. Well, I want to move on to cap rates. So, healthcare real estate properties, they've always, across the board, they've always been attractive to investors. As we know, there's more sophisticated investors that have a track record, and then there's some that get into it because they have a conversation at a cocktail party that they have to get into medical office properties and healthcare properties. But it is a mission critical, demand driven development, and cap rate compression is occurring, even though we have all of this variability in the market, from real estate dynamics to everything else. But do you see cap rate compression continuing or leveling out?
Well, I mean, I think pre-pandemic, no one really thought that the primary indexes that the 10-year T-note and the prime rate and kind of capital markets indicators were going to go down. They did because it was a response to the pandemic, and they've remained low. So as long as the cost of capital is as low as it is, and the cost of capital can't really go any lower, that's going to place pressure on cap rates, and then all of the uninvested capital that exists, all the demand in the investor markets, whether it's on the real estate side or on the operational side, you combine those two things. You combine a lot of demand with very low cost of capital. Generally speaking, that's going to keep cap rates down. They can't really go any lower because, I mean, the prime rate and the federal funds rate and those things, they can't go any lower. So the spread between those and cap rates could, I suppose, compress a little bit, but it's hard to see it going any materially lower.
You answered my next question with regard to the capital market. So it's good. Yeah. So in general, your outlook of healthcare real estate, I mean, do you see any one trend sort of predominating the market, and, in general, kind of where you see it heading over the next few years?
Well, I'd ask you, when you say it, what do you mean? I think I guess I would push back at the idea of healthcare real estate being monolithic. Of course, like as we've talked about, there's all these different slices of it, and they all have different outlooks. I mean, generally, the things that probably anybody who listens to your podcast is aware of, you have an aging population, you have more investors interested in healthcare real estate. You have a sector that kind of weathered the pandemic and wasn't unaffected, but got through it better than most other sectors. All of those things would make one, optimistic if you were an owner or an investor in healthcare real estate. But again, it depends on where you sit in the kind of continuum of healthcare real estate properties. I don't know if that's an equivocal, an equivocal non-answer to your question.
That's okay. It's a big question, and to narrow it down. So I'll ask a question that we haven't touched on. So I think you both of us sort of read and listen to the same industry information, and one thing that I've heard healthcare companies say is, give us something different. And in response to obviously the severe acute clinical healthcare services, they need to be in a clinical environment. But I think what may or may not happen with the result of the pandemic is focus on health and wellness. Let's offer in community health. Let's try to get ahead of any healthcare conditions or monitor them, or at least be aware of them, instead of having a pandemic say, oh, you're not healthy and you're going to be affected more. So if they're more of a health and wellness environment, do you see those being, obviously urgent cares have already been doing this, being in more convenient locations. But for example, if there was like a mixed use development where there was multifamily and retail, and maybe like a health and wellness clinic to go and get like annual physicals, or go and get some checkups that then get sent to your primary care physician, which may be in a different location, but it's convenient for the patient to go in and do this. And with technology becoming more sophisticated, people can do this where they live. instead of having to go to either a campus or a clinic that may or may not be convenient. Do you see anything like that happening?
Well, I mean, convenient access to care, I think, agree 100% that is a trend that'll, continue to accelerate. And what does that mean? It means both, in the case of some care, more, remote or virtual care, and that means more, outpatient sites that are easy in, easy out. The kind of larger question of health and wellness, I think I think about that, I guess, in the context of this long-term but very, very slow trend towards more value-based care. And when you have more healthcare providers who may also be insurers, kind of the Kaiser model, or cases where there's, in theory, an alignment to drive down overall cost of care. Mm-hmm. And I think, like, you've seen a lot of investment in the behavioral health sector from really from all sorts of different entities. Because if you can prove out and then financially incentivize treatment of, say, a behavioral health condition that results in less chronic episodes occurring afterwards, then you've reduced overall system cost of care. So, if a hospital is fully responsible for kind of a patient life from cradle to grave, then it's not just about, revenue associated with, episodic fee-for-service care. It's about, hey, if I can effectively treat this behavioral health episode, then there may not be the same requirement for some of these other types of care. And I think that the system will continue to inch along towards that as we're better able to kind of track and quantify the impact of say certain types of wellness care, and as government continues to incrementally and gradually try to tie more reimbursement to value. So long answer to your question, but yes, I think that the wellness sector is certainly a high growth one that should probably continue to remain so.
Well, Victor, thank you for all of that. So I'll give you we'll go to some easy questions and get to know you. Okay. So what was your first job?
I probably, mowing lawns as a kid is informal first job, and then, waiting tables, washing dishes at later ages.
Builds character. So what would you be doing for a living if you were not working in the healthcare real estate industry?
I don't know. I mean, this is I planned on this from early childhood. So I don't know. Like I said earlier, I was a creative writing major in undergrad, so I'd probably be either trying to do that or maybe have failed and wound up doing something else, being attorney, or I have no idea. All sorts of different things.
Who are you reading or listening to right now for news, information, or inspiration?
Well, just yesterday I finished a book called "She Never Told Me About the Ocean" by a friend of mine, Elizabeth McKetta. It's a nice novel. And next in the queue, I have this book on my desk, "Underland" by Robert McFarland, which is about the underworld, from a literal perspective, what lies underneath the surface of the earth, and then also from a mythological and literary perspective as well.
Oh, very interesting. What is one thing you do every day for healthy self-care?
Well, I do a lot of rock climbing, so I don't do that every day, but I try to climb when I can and try to stretch and do those sorts of things.
What was your last rock climbing adventure?
I went bouldering yesterday up at a place called Guanella Pass in Colorado.
So is Colorado a choice to live because you're able to pursue that?
Well, I lived out here many years ago and had a bad accident, broke both legs actually in 2005, and that sent me back to Texas. That's a whole another story and led to me working in this industry actually. And then I moved back out here 4 years ago to help open our Denver office.
Oh, very nice. Oh, so in your opinion, are leaders born or are they trained?
Can I say both? It's
Yeah.
in the nature nurture dichotomy, I think it's always both.
Yeah. Well, great. Well, thank you, Victor. This has been a great interview. I appreciate your time.
I really enjoyed it. Thank you.